Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host Tim Miller. G'day, Tim. How are you?
Yeah, going well, Aaron. How are you doing?
Not too bad, thank you. Well, today we're going to be talking about SMSF tax planning. It is an upcoming webinar, and we know there are many professionals that listen to this, but might be juggling last-minute lodgements. But many of the clients will be looking towards 30 June and the strategies that they can be taking advantage of. But to undertake these strategies, there are a number of key things that you really need to be on top of to be able to utilize these. And Tim, today we're going to be exploring some of those areas that you need to be on top of to take advantage with these items that we can utilize in SMSF tax planning season. So I'm going to kick off the first thing for you that we highlight here, and that is just around understanding available cap space. And that can take on many different things. So I might get you to elaborate a little bit further there.
Yeah, and I guess sort of the way I would start that is just sort of reiterating the point that you made about lodgement season versus planning season. You know, we have this ultimately this very short window that's relying on the fact that we've lodged our returns for the previous year, which then gives us insight into certain things that are available to us in what then becomes a very short time frame of potentially May and June to actually activate some of these strategies. And so things such as available cap space, as you say, means many things to many people. Ultimately, it comes down to both concessional and non-concessional contributions, but then it goes beyond, say, the standard annualized caps, 30,000 for concessional and 120 for non-concessional at the current state, into based on your total superannuation balance at the previous 30 June. You know, how much concessional cap space do you have, and how much non-concessional cap space do you have? And of course, for those with less than $500,000, it's then what unused cap space have you also got from previous years, which that will dictate what your available cap space is going to be.
Yeah, so then looking at something where we're going back and we can go back up to 5 years, it's that concept of if you don't use it, you'll therefore lose it. And we
Yeah.
now are in that cycle where if that is not being utilized, then those contribution opportunities in essence will just fall off.
Yeah, that's right. And you know, and the unused carry forward concessional concept is obviously one that for some people there's not going to be any need for it in certain years, but you might have a big tax event in your personal life, which is going to be something we'll touch on in a moment, that dictates that it may be a good year for you to claim a larger tax deduction. And so it's whether you have the space to put more contributions in than you otherwise would normally do.
Yeah, and that equally therefore raises the opportunity to look forward around contributions as well.
Yeah, absolutely. And so it gives us that opportunity to look forward to, you know, should we be doing it now? What are our objectives in future years? What is our balance going to be at the end of the current year? So it gives us that opportunity to look at a number of different strategies to work out from a timing point of view and from a tax point of view, what's the best position we can put ourselves in.
So what's the mix we ultimately can take advantage of across a number of contribution strategies? And really we'll be diving into those in our upcoming webinar.
Yeah, absolutely.
So you touched on our next topic just before that we need to be across, and this is our total superannuation balance, because it is interwoven into so many things about how we can make contributions and how we move into a retirement phase. So why is this so important to get right when we look at tax planning season?
Yeah, well, I think, and to go back to one of the points that we spoke about just briefly, was the concept of available cap space. Now, the available cap space, or indeed your concessional contribution cap, is something that is highlighted on MyGov. The other thing that's highlighted on MyGov is total superannuation balance, and it's been a bugbear of the industry for a long time to have that information more broadly accessible to people from a tax planning point of view. I note that you know, it's been contemplated as part of the ongoing negotiations or discussions with Treasury, Tax Office, all those other parties about getting that information and making it more available. But the total super balance, which is part of that broader reporting, is critical because it's the trigger. Well, firstly, it's obviously a representation of what our balance was at 30th of June last year, with some modifications. But it's also then the trigger for determining, okay, do we or are we eligible this year for such strategies as the carry forward of the unused concessional contributions? But it's also for the higher balances the trigger for what is our non-concessional contribution cap, and are we able to avail ourselves to things such as the bring forward contribution strategy. So not only having an appreciation for what your total super balance is, which you can't do until the financials are completed and the fund is lodged, but also whether there's any opportunity to manually adjust the total superannuation balance to recognise certain events such as property transactions or future income tax benefits, deferred tax liabilities, those sorts of elements. How can they assist you in determining what somebody's total super balance is?
Yeah, absolutely. And I think the final one has, again, application across individuals, so the member themselves, but then also at a fund level. And that is the understanding around the assessable income position of that individual or entity, and why, therefore, is that so important in the context of our, sort of final 6 to 8 weeks of the financial year.
Yeah, and the key element of assessable income, and as you quite rightly highlight, is it's an individual based issue, but it's also a super fund issue as well. Because from an individual point, what income are we going to pay tax on? Is there a way to reduce that, and what strategies can we apply to by utilizing super strategies to offset that tax? But then equally, from a fund point of view, is there any strategies that we can undertake within the fund to reduce the fund's tax liability? Whether or not it comes down to the fact that if you've got members that are of pension age, whether they should be paying pensions or not, and what method, from an ECPI point of view, from an exempt pension income deduction point of view, are they utilising, and is it the best method? Is it going to get them the best tax outcome for the current year? So the whole concept of assessable income becomes quite critical at this time of year.
Yeah, absolutely. So these are, I guess, what we've seen as 3 key areas that you want to get right. So going back and looking at and understanding the cap space position. So what is available, looking back historically, looking at the current year, and potentially looking forward if you have the opportunity to take available the concessional contribution, say using a reserving strategy. TSB is, as I mentioned before, a key part of the overall landscape of the superannuation laws, and it impacts not only contribution strategies, but also impacts many other areas like retirement phase as well. And then understanding the tax position of the fund and of the individual then opens up many of the opportunities around CGT, deductibility of contributions, ECPI, as Tim said, and much, much more. So I guess in summarising that, Tim, there's a real large opportunity for practitioners in this sort of last couple of months to really take advantage of some of the wonderful strategies and cross-pollinate many of these strategies, in particular when it comes to contributions. And these are all things that we are going to highlight in our upcoming SMSF tax planning webinar on the 7th of May.
Absolutely. And I think the key for that, Aaron, is that what we're doing is we're preparing people for 30 June, but by preparing people for 30 June, it's also putting the process in place to be able to hit 1 July running as well.
Yeah, absolutely. So if you do want to find out more about this upcoming event, please visit our website, smartersmsf.com/events. And what I should say, Tim, is each and every year, those that attend do get access to our SMSF tax planning checklist and reference guide that gives a huge amount of benefit to employ the checklist with your clients as you're working through this, and giving you all the technical references and detail that you need to know and understand as you work through these opportunities with your clients.
Indeed, and of course, it's not unlike the ATO at this time of year to change their entire website and to change the links. So, of course, a big part of my job is to make sure that all those links work, so that people can have those easy access to the reference materials we provide.
Yeah, absolutely. Well, thank you once again for joining us this week's edition of Feeling Smarter. We hope to also see you at our upcoming SMSF tax planning event. Have a great rest of the week. Bye for now.
See you all.